Trump just promised the stock market will double. Gold just hit $4,437 an ounce. One of these things is telling you the truth. Let me explain why the gold market right now feels like watching two completely different movies playing on the same screen, and why so many of you are sitting there staring at your portfolios with this knot in your stomach that you cannot quite name. Is it fear? Is it FOMO? Is it the creeping regret of not acting sooner, or the shaky relief that maybe you did? If you are feeling all of those things at once right now, you are not alone. And more importantly, the market data actually backs up every single one of those feelings. Here is where we start. President Trump went on the record this week claiming the stock market will double by the end of his term. Now let us just sit with that for a second. Doubling the stock market from current levels would require a roughly 100% gain in under 4 years, in an economy where real GDP growth is currently running at just 1.5%. Not 5%, not 8%, 1.5%. That is barely above stall speed for an economy the size of the United States. The last time the stock market doubled in a 4-year window was the late 1990s tech bubble, and we all know how that movie ended. So when the President of the United States makes that claim while gold is simultaneously sitting at $4,437 an ounce, something deep in your gut is probably telling you that one of these signals is not like the other. And that gut feeling has data behind it. Let us talk about what gold is actually saying, because it is not just saying stocks are overvalued. It is saying something much more specific and much more alarming. The US CPI index right now sits at 332.813. For context, that index was at 100 in the base year of 1982. So the purchasing power of the dollar has been hollowed out by more than 230% since the year Pac-Man was in every arcade. Gold in 1982 was trading around $300 to $400 an ounce. It is now at $4,437. That is not a bubble. That is a 35-year report card on what paper money actually does over time. Now here is the question everyone is actually asking, and I want to answer it honestly instead of the way most channels do. Does gold hit $5,000 by end of 2026, or do we pull back hard below $4,000 first? A lot of you have been asking this in the comments, and you deserve a straight answer instead of a price target dressed up as research. I am not going to sit here and give you a price target dressed up as research. What I can do is show you the structural mechanics that are still very much in motion, and let you draw your own conclusions. Here is one of them. Every time in modern history that a sitting US president has made aggressive public claims about stock market performance, it has coincided with a period of peak institutional anxiety about the underlying fundamentals. Think about that. Not peak confidence, peak anxiety. The loudest cheerleading tends to happen precisely when the numbers underneath stop doing the cheerleading on their own. Let me give you another fact that I almost guarantee you have not heard on mainstream financial television. Central banks globally bought more than 1,000 tons of gold for the third consecutive year in 2024. 3 years in a row above 1,000 tons. That has never happened before in recorded central bank history. These are not retail investors panicking. These are the institutions that literally print and manage national currencies, and they are trading their own paper for physical gold at a historically unprecedented rate. When the people who make the money do not want to hold the money, that is not a subtle signal. That is a flashing red light in a language that does not require translation. And this connects directly to why so many of you are feeling this emotional whiplash right now. The mainstream narrative is still telling you that gold is just an inflation hedge, a relic, a bumper sticker asset for people who distrust modernity. But if that were true, why are the most sophisticated sovereign balance sheets on earth rotating into it as fast as they can? Why is gold up roughly 40% over the past 12 months while real GDP growth sits at 1.5%? That divergence, the gap between what the economy is actually producing and what hard assets are pricing in, that is the thing that should make you feel something. Because it means the market is pricing in a risk that the official narrative has not yet publicly acknowledged. Here is another layer to this. Trump's stock market doubling claim is not just a political statement. It is a pressure campaign on the Federal Reserve. When a sitting president publicly stakes his legacy on equity market performance, it creates enormous political pressure to keep rates low or cut them, to keep liquidity flowing, to do whatever it takes to keep the number going up. And historically, every time that political pressure has overridden monetary discipline, gold has responded. Not immediately, not on a neat schedule, but structurally and with conviction. The 1970s are the textbook case. Political pressure kept real rates negative for years. Gold went from $35 an ounce in 1971 to $850 an ounce by January 1980. That is a gain of roughly 2,300% in under 9 years. I am not saying that happens again at that scale. I am saying the rhyme is worth listening to. Now let me be real with you about the emotional side of this, because that is the part most financial channels skip. If you have been watching gold climb from $2,000 to $2,500 to $3,000 to now $4,437, and you did not have as much exposure as you wanted, the feeling you are sitting with right now is a specific kind of pain. It is not panic. It is something quieter and more corrosive. It is the feeling of being right about the thesis but not acting on it fully enough. And that feeling, left unexamined, is one of the most dangerous drivers of bad financial decisions. It pushes people to chase, to buy at the top of a spike, to abandon their process because the emotional cost of watching from the sidelines becomes unbearable. I am not telling you what to do, but I am telling you to name that feeling before it names your next decision for you. Because here is the grounding fact that cuts through all of the noise. The structural case for gold is not based on one president's tweet, 1/4 of GDP data, or one central bank's decision. It is based on a multi-decade erosion of fiscal discipline across every major economy on Earth. The US national debt crossed $36 trillion this year. Global debt to GDP ratios are at levels that have historically resolved in one of only two ways, restructuring or inflation. Neither of those outcomes is good for paper assets held at face value. Both of them have historically been very good for gold held physically. That is not a prediction. That is a pattern that has repeated across the Roman Empire, Weimar Germany, 1970s America, and every major currency debasement cycle in between. So where does that leave you right now? Gold is at $4,437. The economy is growing at 1.5%. The president is promising a stock market double. Central banks are buying gold at record rates. Real purchasing power has been cut by more than 230% since 1982. Those are not vibes. Those are facts. And they are all pointing in the same direction. You do not have to feel panicked by that, but you probably should not feel indifferent to it either. The people who make the calmest, best-timed decisions in markets are usually the ones who did their research before the emotional moment arrived, not during it. If you want to keep getting this kind of data-grounded, emotionally honest breakdown of what is happening in gold and macro, hit subscribe. Every week on this channel you get the numbers, the historical context, and the structural analysis that most financial media either skips or buries. No hype, no price pumping, just the real picture. And here is something most channels will never admit to you. The data we covered today is the same data institutional desks are quietly briefing their own clients on right now. One last thing before you go. I am not a financial advisor, and nothing here is personal advice for your situation. But I will say this much. The investors who came out ahead after 2008, after the 1970s, after every major macro shift, were not the ones who waited for permission. They were the ones who understood the picture early and made decisions that fit their own life.